And welcome back to our lesson today on advanced charting and the art of form reading. Some of the things we'll be covering in this lesson include understanding the basic concepts of form reading, identifying price patterns, and understand how support and resistance combines with price patterns and form reading. So first up, we're going to take a look at what's known as form reading. Form reading is the study of individual bars that occur on our charts. Specifically, we look at the open and close relationship of each bar. We look at the range or size of the bar. So the range is the distance from the low to the high of the bar. The dash on the left, of course, is the open. The dash on the right is the close. We also compare the open and close in relation to the high and low of the bar. So first up, just generally closing above the open would be a bullish bar and would suggest further upward movement. But an even stronger signal than that would be if it were to open down near its low and close up near its high. So it's opening and closing near the extremes of the day. As a result, this has even a higher chance of continuing up further for the following period or bar. Now, another thing you can look at with form reading is in conjunction with one of the pre-alerts known as the market conductor dots. So green dots basically occur when it's in a short-term uptrend. Red dots typically occur when it's in a short-term downtrend. So we can compare the closing price in conjunction with the market conductor dot. So if you've got green market conductor dots, if it's continuing up further, you'd like to see closes above the green market conductor dots. If, on the other hand, if you look at the second last bar up here, it's closed below the green dot, well, that's not a very good sign for the short-term uptrend and would suggest a downward movement from this level. Conversely, if you've got red dots, ideally you want to see closes below the red dots. So if you look at the last bar here, which has got a red dot on it, it's actually closing above that red dot, and therefore a pretty good indication the next bar is likely to move upwards from this level. Now, the other thing you should be aware of with form reading is it's best used on weekly charts or higher time frame charts, so weekly, monthly charts, for example. We can do it on daily charts, but you'll find you'll get a lot more short-term noise, more sort of false signals that occur on a daily chart. Weekly chart, you've got 5 times as much trading activity, therefore they tend to be a little bit more reliable in terms of form reading signals. So things to look for with form reading, look at the open and close, compare it to the high and the low of the bar, is something we've discussed. Obviously opening down near the low, closing up near the high is bullish. But what if you had an open and close towards the middle of the bar? That would actually suggest a little bit of indecision. Or the other thing that can happen is both the open and close up near the high would be really bullish, or both the open and close down near the low, that would be extremely bearish. So when we talk about comparing the open and close to high and low, there's a number of scenarios we can look for with that, but certainly both the open and close down near the low end of the bar would be bearish. Both the open and close up near the high end of the bar would be bullish. Now, these types of bars actually are known as key reversal bars. So it's a specific pattern known as a key reversal when you get both the open and close up near the high or both the open and close down near the low. And of course, as we've discussed, we can compare the closing price to the market conductor dots if we have them on the chart. Green dots if it's going up, so if so, you want to see it closing above those green dots. Red dots if it's going down, so ideally it'd be closing below the red dots in a downtrend, but if it closes above the red dot, it's indicating the start of a new uptrend getting underway. All right, so these are examples of key reversal bars. So notice how both the open and close sit up near the high end of the range in the first two examples. If so, that's very bullish. A lot of trading activity has taken place to push that closing price right up back towards the high end of the bar. If both the open and close are down near the low, this is quite bearish and would suggest further downward movement from here. All right, and that's again the same chart, just shown to you as a candlestick chart, so a different type of chart style. And you can see these key reversal bars stand out quite clearly with the candle style chart. So you got the body of the candle right up near the high end of the bar. You got this long tail that sort of hangs down. So as a result, they stand out as a bar that's got lots of buying pressure, that's been bought up strongly, closing up near the top end of the bar. And of course, if the open and close are down near the low, the body of the candle will be down towards the low in the bar here as well. This makes it quite bearish. So this pattern, in terms of Japanese candlesticks, if it's closing up near the high end of the bar, it's known as a hammer, bullish pattern. Closing down near the low end of the bar, it's known as a shooting star. So they're exactly the same pattern as a key reversal, just a different name because it's a candlestick chart. Now, gapping is something you'll certainly see a lot of on a chart, and gaps can tell us a fair bit of information about the short-term trend. So if we've closed above the open, closing up near the high end of the bar on the day before, it actually suggests further upward movement is likely. Not necessarily a gap, but should it gap and then follow through with a strong close above its open, physically leaving a gap on the chart, which you can see here, then that's a sign of a very strong trend, likely to continue. So if we get a gap up and a strong follow through close, closing above the open up near the high end of the bar, there's a pretty high chance of further upward movement from that level. And the reverse of this, in a downtrend, gapping down, closing below the open, down towards the low end of the bar, physically leaving this gap on the chart, suggests weakness and further downward movement from these levels. So here's examples of gapping. Certain stocks will gap more frequently than others. Gaps can be caused because of overseas overnight trading. They can be caused because of announcements. They can be caused because of ex-dividend dates. All these sorts of things create gaps on our chart. But what we want to look at is how is it opened and closed the following day after the gap, and it can give us a bit of a feel for which way it's heading after the gap. Now, a very well-known form reading bar is known as an inside day. An inside bar has a lower high to the previous high. It has a higher low to the previous low. So the entire range of this bar is within the range of the previous bar. So it's known as an inside bar. And then we should always look at where is it opening and closing on the inside bar. Close above the open, up near the high, would make this bullish, particularly if it's occurring at the end of a downtrend here. Typically, we see inside bars well before the break of a down trend line. So we then just wait for the break of trend line, and that would be a pretty significant upward reversal being suggested from that level. They also occur at the end of uptrends. So once again, the definition of an inside bar is the bar has a lower high to the previous bar, and it has a higher low to the previous bar. Again, only comparing the current bar to the previous bar only. We then look at the opening close, closing down near the low. This obviously is bearish and would suggest weakness towards the end of this uptrend here. Once again, notice how this inside bar has occurred before the break of this rising trend line. So should it then go on to break the rising trend line, this would be quite bearish and suggest further downward movement from this level. Now, the opposite to the inside bar is known as an outside bar. you'll notice it's got both a higher high to the previous bar and a lower low to the previous bar. So it is literally outside the range of the previous bar. We then look at the open and close for further information as to which way it might be heading. So close above the open, close up near the high. It's obviously quite bullish and would suggest further upward movement. Now, outside bars are generally much larger than inside bars, so there's a lot more trading activity, you could say, that usually goes into making an outside bar, therefore usually more committed in terms of that direction. And quite often they will break up through a downward plotting trend line, offering an entry signal close above the trend line, as well as being an outside bar. So this would be quite bullish, particularly if that's occurring at the end of a downtrend or a pullback, suggesting a start of upward movement from this level. They also occur at the end of uptrends. So again, notice this outside bar has a higher high and a lower low to the previous bar. It's closing below the open, closing down near the low, in fact, in this case, closing right on the low. It's also broken that upward plotting rising trend line, and closed below the trend line, which makes it a bearish signal and suggests further downward movement from here. All right, so here's a chart. We see a couple of examples here. Up the top is an inside bar occurring at the end of an uptrend. Close below the open, down near the low. So that's bearish, suggesting some downward movement associated from here. And at the end of the downward movement, we have a nice large outside bar, close above the open, up near the high. So it's bullish. It's being bought up, suggesting further upward movement from this level here. All right, so that was our lesson on form reading. What we're going to look at now is price patterns. So price patterns consist of multiple bars, whereas form reading, we're talking about individual bars. So these are patterns. Looking at the overall ebb and flow of the chart to find patterns, suggest direction in terms of which way the price action could be heading from these levels. So the first one we're going to look at today is called a false break pattern. You get false break lows that occur at the end of downtrends, and you also get false break highs that occur at the end of uptrends. So firstly, false break low, it's got to be in a downward trend. We need a little V low to be in place. So in other words, it's been going down, and then we have at least one or two bars going up. So this creates this little trough low or V low. And then we want that little rally to start failing, and then we look for a bar to actually break through this trough low over here on the left. So one of the first criteria of a false break low is it must break through the previous trough low. Then you want it to close above that trough low, and that confirms a false break low. All right, so there's two elements to this pattern. Must firstly break down through the trough low, and then must close above the trough low. And that suggests a false break in the downward direction and a reversal, upward reversal, likely to get started. Again, if you were to draw a down trend line on this peak here, this pattern usually happens well before the break of a downward trend line. So it's pretty bullish. And as we've said, they occur at the end of uptrends as well. So if you have a false break high, you need a peak, a minor peak that has occurred. So a rally followed by a small decline, creating this little peak high. And then it needs to rally past the peak. So break through the peak, and then specifically close down below the peak. All right, so it has to do two things: must break through the peak, test these higher prices, then sell off, and then close back down below that peak, and that constitutes false break high pattern. And that suggests further downward movement from this level. All right, so there's an example of a false break low on an actual chart. So it's been going down. We've got this little trough low or V low that's happened on the way down. That little counter rally starts to fail. It begins to continue the downtrend, we look specifically at the bar that makes the final low, and two things have to have happened. It has to have broken down through the previous trough low, so it's making a new low, and then secondly, it must close back up above that trough low, and that constitutes a false break low. So it's a bullish pattern. Notice it's happened well before the break of the trend line. Now, what's also interesting about this example, if you look closely at the bar we've just described as being the false break low, it's also an outside bar as well. So not only was it a false break low, it's also a bullish outside bar closing above the open up near the high, and obviously suggest further upward movement from there. Now, with any pattern, we should always wait for a breakup through our down trend line before acting on the signal. So look for a close or two above this trend line before considering buying it as a trading opportunity. All right, so this is a false break high pattern now. And again, just by coincidence, the bar, which is the false break high, just happens to be an outside day again. But that's, again, just a coincidence. It doesn't have to be an outside bar, but it's obviously better if it is, because we've got more than one pattern suggesting a reversal, haven't we? All right, so what constitutes a false break high? We've got to have a little peak high here. So a rally followed by a decline, a little V high or peak, if you like. We look for the bar that has made the final high. Two things must have happened here. It must have broken up through the peak, testing higher prices, and then it has to sell off, and specifically it must close below that peak, and that constitutes false break high. So this is a bearish pattern. Once again, if you had a trend line drawn on that, this would typically happen well before the break of trend line, and should it break the trend line, it suggests further downward movement from this level. Then we have double tops, and you also get double bottom patterns as well. So let's start with the double top pattern. Double tops show us resistance at price levels previously rejected in the past. The further apart they are, the stronger the signal. They're ideally spotted on a weekly chart, but certainly you will see them on daily charts as well. And basically allow roughly 3% between the price tops. So when you're looking at a double top, so it's two peaks you're going to be looking at, very rarely will they be perfect double tops exactly the same price. So the second peak here is allowed to be slightly above that first peak or slightly under that first peak by as much as 3% of the price value of the first peak. All right, so work out what's 3% of the price value of the first peak, and it's allowed to be slightly above that or below it by that sort of variance. And then we'd say, okay, well, that's a double top pattern. You can see you can draw a horizontal line generally connecting those two peaks or very close to those two peaks. It's a bearish pattern. It suggests resistance and further downward movement from these levels. So there's an example of a double top that in this case was occurring at the end of an uptrend. So two peaks almost exactly the same level or very close to it. As long as it's within 3% of the first peak high is fine. We've just drawn a horizontal line there connecting those peaks to show you that. Wait for the break of the rising trend line, and there's the downturn from here. So it's a bearish pattern. Next on the list is the opposite to the double top is a double bottom pattern. So this is a bullish pattern now. Basically two troughs lows that suggest support and further upward movement from these levels. Further apart they are, the stronger the signal, ideally spotted on weekly charts, but yes, you can spot them on dailies as well. And the same sort of variance factor. Look for the second trough to be above or below the first trough by as much as 3%. So that's the concept, two trough lows, basically the same sort of levels. Draw a horizontal line across connecting those two trough lows if you can. It's obviously suggesting upward movements, a bullish pattern from these sort of levels. And there's an example of a double bottom. Now there is such a thing as a triple bottom as well. It's just three troughs instead of two. So you could argue this is not a bad example of a triple bottom, but they have the same meaning, support and further upward movement from these sorts of levels. Wherever possible, draw in a downtrend line, and typically we wait for the break of the downtrend line before we enter. All right, then you got triangle patterns, and there's actually 3 different types of triangles you can spot. You got a symmetrical triangle, you got ascending triangles, you got descending triangles. So firstly, symmetrical triangles will have both lower peaks and higher troughs. So they'll actually squeeze into like an apex, and then it will break either way. And generally they break in the direction of underlying trend as a rule of thumb, but they can break in any direction. Whereas an ascending triangle is actually a very bullish sort of pattern. It's got higher troughs that are forming, and that's the reason it's bullish, because it's making higher troughs. And then it's squeezing into a horizontal line of resistance. And of course, we just wait for it to break through that horizontal line of resistance, giving you a breakout type trade, and further upward movement is suggested. Descending triangles are the opposite to this. They are bearish patterns. The reason they are bearish patterns is because it's making lower peaks, squeezing into horizontal support. And then we just wait for it to break through that horizontal line of support, and that would suggest further downward movement. So first up, this is what an ascending triangle looks like. So we've got a series of higher troughs, making it bullish. We've got equal peaks where we can draw a horizontal line connecting those peaks. So really you need at least 2 peaks, preferably 3, to get that line connecting all those peaks running across there. Wait for it to close above that level. So it's got to break through that horizontal line, looking to buy in on either the first or second higher close above that level, and that should be the start of upward movement from that level. So it's a bullish pattern, ideally spotted in an uptrend, so trade with the trend. And the opposite to the ascending triangle is the descending triangle. It's a bearish pattern, ideally spotted in a downtrend. So it's bearish because it's got lower peaks. So you should be able to draw a downtrend line connecting the lower peaks. Then we're looking for a horizontal line of support connecting troughs, so equal troughs. Look for it to break through that level, and that makes it bearish. Symmetrical triangles are trendless. They can break in any direction as a rule of thumb. The odds favor it will usually break in the direction of underlying trend. So that's generally the meaning behind this pattern. But with the symmetrical triangle, what you're going to see is a series of lower peaks, which allows you to draw the downtrend line on the peaks, and higher troughs, allowing you to draw a rising trend line on the troughs. And you can see it squeezes into this little apex here. And we're looking for it to break through one of those trend lines. So first, second close above or below the trend line, and we can basically gauge direction from there and potentially a trading opportunity. So that's the symmetrical triangle. Now, another pretty simple pattern to look for is known as a first higher bottom pattern. It's basically a higher trough, but it's specifically the first trough up from the extreme low. So here's the downtrend. This is the final low that's been made, and then it rallies, and then we get this higher trough, higher bottom. So we call it the first higher trough or first higher bottom. And it's actually usually the start of a new uptrend getting underway, and usually a medium-term uptrend getting started here. So it's quite a bullish pattern. It's even more bullish if it's finding support on a downward trend line like that. But that's the first higher bottom pattern, and usually suggests the start of a pretty decent medium to longer term uptrend. The opposite to the first higher bottom pattern is your first lower top. And in this case, and again, for it to be the first lower top, we wait for the final high to come in. We look for a lower peak to form. And in this case, it's actually also a great example of this lower top finding resistance below the trend line. So it's also known as a retest failure pattern. So lower top finding resistance under the trend line, the rising trend line there. So it has a very high probability of finding resistance at that trend line and failing. So this is a bearish pattern. it usually suggests the start of a pretty decent medium to longer term downtrend. These are other examples of first higher bottoms, and these are also examples of higher bottoms pulling back, sitting on the downward trend line, finding support at the trend line. So higher bottom patterns are even more bullish if they're sitting on support, such as a downward plodding trend line. So downward plodding trend lines initially act as resistance, but when the market breaks up through them, it's quite common to see the market pull back and sit on these downward plodding trend lines, and they actually then act as support. So it's a retest of the trend line, which is then acting as support. It's a higher bottom pattern. It's very bullish, and again, has a very high probability of the start of a medium to longer term uptrend from these sort of levels. So quite a powerful pattern when we see them at the end of downtrends. Head and shoulders patterns are bearish patterns. They usually precede strong downward runs. They're reasonably rare in the market, but can be quite profitable if you recognize them. They have a left shoulder, a right shoulder, and a head formation. So let's take a look at the head and shoulders pattern. So this is head and shoulders. All right, so basically it's three peaks that we're looking at. So typically it confirms the end of an uptrend, the start of a downtrend. So left shoulder is a peak. The head must be the highest peak between the two shoulders, and of course the right shoulder is also a peak. But what's important is the head is higher than the two shoulders. Otherwise it's not a true head and shoulders pattern. The right shoulder could also be described as the first lower top pattern, which is a bearish pattern in itself. And quite often, if you spot a head and shoulders pattern and you're looking at the right shoulder closely, it's just about always your first lower top pattern. And as we know, that is a bearish pattern suggesting downward movement. So getting good at spotting your first higher bottom, first lower top patterns will help you spot the head and shoulders patterns here and the reverse head and shoulders patterns here. All right, so reverse head and shoulders are the opposite. They are bullish patterns. So now we're looking at trough lows. So left shoulder is a trough, right shoulder is a trough. The head must be the lowest trough between the two shoulders. And as we said, the right shoulder is just about always your first higher bottom pattern. If you're lucky, it might be finding support at your trend line. And all of that suggests support and further upward movement from these sorts of levels. Okay, a little exercise for you to do at home. When scrolling through your charts, try and find the patterns discussed in this module. The more you perform this exercise, the easier recognition becomes. So literally spotting patterns is a little bit like training your mind to see them. So one of the best things you can do is go through a watch list like the top 20 stocks, for example. Sit down and try and sit there until you see an inside bar. Check the daily charts, check the weekly charts. Once you started to see inside bars, try spotting an outside bar. Once you're seeing those, try looking for a false break low or a false break high, or a double bottom pattern or a double top pattern. And eventually your mind starts picking up on these patterns and will recognize them as the pattern is forming in front of you. So I hope you enjoyed our lesson today on price patterns and form reading.